Hi everyone, and welcome to SIC Forex. Feel free to like, comment, and subscribe for more content. I hope you are having a successful trading week. In this video, we'll be discussing algorithmic trading or algo trading. This means we'll be taking a closer look at what is algo trading in Forex, the advantages of algorithmic trading, and the basic types of algorithms traded in the financial market. Algorithmic trading, also called automated trading, black box trading, or algo trading, uses computer program that follows a defined set of instructions, an algorithm, to place a trade. The definition of an algorithm is essentially a set of specific rules designed to complete a defined task. Algorithmic trading allows traders to establish specific rules for both trade entries and exits that, once programmed, can be automatically executed via a computer. In financial market trading, computers carry out user-defined algorithms characterized by a set of rules such as timing, price, or quantity that determines trades. Traders and investors can turn precise entry, exit, and money management rules into automated or mechanical trading systems that allow computers to execute and monitor trades. One of the biggest attractions of Forex strategy automation is that it can take some of the emotion out of trading, since trades are automatically placed once a certain criteria are met. The trade entry and exit rules can be based on simple conditions such as a moving average crossover, or they can be more complicated strategies that require a comprehensive understanding of the programming language specific to that user's trading platform. Algorithmic trading systems can also be based on the expertise of a qualified programmer. Algorithmic trading typically requires the use of software linked to a direct access broker, and any specific rules must be written in that specific platform's proprietary language. Technological advancements have transformed the Forex market, and a significant change is the introduction of algo trading, which may have led to improvements to the functioning of Forex trading, but also poses risks. Computer systems and algorithms are helpful in automating Forex trading strategies, especially when the markets are traded virtually 24/7. A major advantage of automated Forex trading is the elimination of emotion and psychological influences determining trading decisions in favor of a cold, logical approach to the market. Another advantage is algorithms can be used to search for patterns in historical data for developing new market models. There are four basic categories of algorithmic trading systems within financial markets. Number one is statistical, which refers to an algorithmic trading strategy that looks for profitable trading opportunities based on statistical analysis of historical time series data. Number two is an auto hedging strategy that generates rules to reduce a trader's exposure to risk. Number three, algorithmic execution strategies aim to execute a predefined objective, such as reducing market impact or executing a trade quickly. Number four, direct market access describes the optimal speeds and lower costs which algorithmic traders can access and connect to multiple trading platforms. One of the subcategories of algorithmic trading is high frequency trading, which is characterized by extremely high rate and speed of trade order execution. Most of the algo trading today is high frequency trading, which attempts to capitalize on placing a large number of orders at rapid speeds across multiple markets and multiple decision parameters, based on pre-programmed instructions. High-frequency trading can give significant advantages to traders, including the ability to make trades within milliseconds of incremental price changes, but also carry certain risk when trading in a volatile market. Let's look at a few benefits of algorithmic trading. Firstly, trades are executed at the best possible price because trade order placement is instant and accurate. There is a high chance of execution will be at the desired levels. Trades are timed correctly and instantly to avoid significant price movements. Algorithmic trading has reduced transaction costs in Forex trading. Automated Forex systems are able to simultaneously automated checks on multiple market conditions. Algo trading reduces the risk of manual or pilot errors when placing trades. Algo trading can be backtested using available historical and real-time data to see if it is a viable trading strategy. Automated trading systems reduce the possibility of mistakes made by human traders based on their own emotional and psychological factors. Algorithmic trading strategies such as auto-hedging, statistical analysis, algorithmic execution, direct market access, and high-frequency trading can expose price inconsistencies, which creates profitable opportunities for traders. In conclusion, algorithmic trading has been able to increase efficiency and reduce the cost of trading Forex, but it has also come with added risk. You should expect a learning curve when using automated trading system, and it's generally a good idea to start with small trade size while you refine your process. It is important to remember these are computer software programs that are limited in their capabilities and are not foolproof. There is no such thing as a holy grail in trading, manual or automated. In my opinion, using automation in Forex can give you the edge as a trader as long as you manage your risk. If you want to learn more about trading Forex through automation, feel free to subscribe for more content. If you enjoyed this video, please hit the like button as it really helps the channel with the YouTube algorithm. Thank you for watching. Until next time, happy trading.